Friends, welcome to the class 16. We have already covered 15 classes with respect to our full knowledge on the banking credit analysis course. So in this class, we will discuss a very important concept that is called loan to value ratio, LTV in short form, and collateral cover. Both are interchangeable terms. Some banks use the term LTV and some are using the term collateral cover. They both represent the same thing only, right? So before starting this lecture, there was one small topic that I missed to explain in the previous video with respect to the risk factor on the plot part, right? In the previous video, we have discussed that the property that is residential, commercial, industrial property, if self-occupied, vacant, rented, under construction, they have different risk factors associated with them. Similar to this, the plot property is also having a different risk levels with respect to the area where they are located. If the plot is located in residential area, and the area is having a good development, a decent development with minimum, you can say many banks has the internal policy that the minimum development in the residential area should be 50 to 60% of total land size of that area. So if the 50 and 60% of the area is habitual, people are living there, they have made their houses, the resi area is good, then it is called resi plot. So taking a resi plot is a better combo than taking a standalone vacant plot that is located outside the city in a distant area in a area which is not developed as of yet. So first is the plot located in resi area. Similar to this, plot located in commercial area. The second preference is plot located in commercial area. So the commercial area, you very well understand, the area which is dominated by the shops, offices, local market. So if the plot is located in that area is good, area has decent habitual decent occupancy of various shops, then this is a second preference. It is taken far more positively by the bank than the other kind of plots. Third preference is the industrial plot. From the name, you can very well say this is the plot located in the industrial area. Needless to say, like industrial property, this is the third preference for the bank. And the fourth one is the other plots. Other plots that are not located in a proper resi area, or if they are located in resi area, the area is totally underdeveloped, not located in commercial area, or located in a commercial area which is totally underdeveloped, not located in industrial area, or located in industrial area which is totally underdeveloped, or plot located outside the city, in the fields, in the area which is not even looked into by the local residents or nearby population. So the plot also have different kind of risk factors associated with them. So this was the small topic that I missed to explain to you in the last video. So coming to the today's lecture, we are discussing about loan to value ratio and the collateral cover. As I have said earlier, both are same terms only. If you look at the formula, loan to value ratio is the loan amount divided by the property value or the asset value into 100. We calculate it in a percentage terms. And collateral cover is just opposite of loan to value ratio. Here the property value comes in the numerator and the loan amount is coming in the denominator instead, right? It is also called calculated in the percentage terms, right? So what this ratio tells you, so suppose if your loan amount is 50 rupees and property value is 100 rupees, you are taking a security with the value of 100 rupees and you are just giving loan equal to 50 rupees. So you are double secured. You have 2 times the security than your risk amount. Your risk amount is the loan amount. You have 2x security than this. So here your loan to value ratio is mere 50%. loan to value ratio is mere 50%. If your loan to value ratio becomes 40%, then it means you are giving only 40% of the value of security as a loan. So lower the ratio, lower the percentage, the better is for the banks, because the banks are more safer if the percentage is on lower side. But it is totally vice versa for the borrower. If the borrower is getting only 30% loan for 100 rupees, 30 rupees loan for 100 rupees property value, then he is not properly discounting the value of property in form of loan from the banks. So the lower ratio is not beneficial for the borrower. Borrower will be more benefited if he gets more loan on his property value, right? So the LTV concept is mainly used in the retail segment when we do the products of LAP, loan against property, home loans. In these products, the concept of LTV is majorly used by the banks. Some banks are using it in business banking segment also, but majority of banks and NBFCs use this concept in LAP or HL products. Now coming to the collateral cover part. In the collateral cover, you are talking about property value in numerator and loan amount in the denominator. What does this mean? If the property value is 100 and your loan amount rupees 50, then it means you have 200% security. You have 200% security, or you have 200% cover. A cover is like when the rain is falling, you have an umbrella cover. How big the umbrella cover is? The bigger the umbrella cover is, the more people can get into that umbrella and more people can get saved from rain. So like this, the property value is a kind of umbrella. And if the umbrella is of rupees 100 value and you are just giving a 50 rupees value of loan, that means there is 2x more space left in that umbrella to cover your risk amount, right? So you are secured 200%. So 200% is the security cover, or we call it 200% collateral cover, right? So higher the cover. So if here the property value goes up to 200 rupees and loan amount remains at 50 rupees, so your cover becomes 400%. So in this, higher the cover, higher the percentage cover, the better it is for the banks, and obviously vice versa for the borrower, right? So collateral cover concept in majority of banks is used by the business banking departments which are doing working capital products, large corporate loans. These departments use the collateral cover concept instead of LTV, right? It's just a manner of presentation of a thing. Both the things meant to explain the same thing to the bank, right? The risk part, the overall risk exposure of the bank does not change whether you use the term LTV, whether you use the term collateral cover. So if we assess these two terms, the formula consists of two items. First is the loan amount, second is the property value or the asset value, you can say. So two things are involved in this formula, right? Loan amount and the property value. So let us come to the loan amount part. How the loan amount is decided? Well, this is a very lengthy discussion. I will have to make 70, 80, 100 of videos to make you understand how the loan amount is finally decided by the banks. What is the whole scene behind it? What is the concept behind it? So there are multiple factors involved in finalizing the loan amount, which are some of these examples are: what is the eligibility coming from your financials, whatever the product is bank using, what is the eligibility, what is the level, what is the risk factor involved in your financial analysis, whether your financials are good or not, whether they are representing any risk to the bank or not. How is your conduct in other banks, in your bank statement with your suppliers and buyers? How is your conduct with them? How is your business? How is the industry performing in the line in which you are doing your business? What is the internal policy of the bank? Internal policies also impact the loan amount decision. For example, everything seems okay, eligibility is okay, everything is okay, but the internal policy says we cannot fund to a liquor trading business. For example, your policy has a term that you cannot fund to a liquor profile business, then everything goes into waste. There is no value of eligibility, financials, conduct, business, market feedback if your internal policy says that you cannot fund to this profile, or you cannot fund more than 2 crore rupees to a liquor trading profile. This is just an example for you. Market feedback impacts your loan amount decision, your net worth impacts it, and your collateral type that we are studying in last 2 lectures. Collateral type and its value also impacts the decision. If you are giving loan of rupees 50 on the property value of rupees 400, then you are 400 times secure. 400 times secure. So this plays a pivot role in deciding your loan amount also, right? So the first one is the loan amount that we will cover in upcoming numerous videos. The second one is the property value or asset value, you can say. Property value. This is an integral part of the formula. So how we determine the property value? How the property value is calculated actually? If you are giving a residential property to mortgage as a security to the bank, how the value of a residential property is calculated actually by the banks. So I am not a technical person. I am not a technically qualified engineer who can assess the property value by using any mathematical formulas or having any specific knowledge about it. I am just a chartered accountant. So I cannot teach you the technicalities behind the calculation of market value of the property. I can teach you whatever I have seen practically done by the banks to assess the property values, right? So this property value is finalized by the technical team of the bank, or the valuers, you can say, that we have studied. The technical team who are qualified persons, they can be external to the banks, they can be internal in the banks. They assess the property value, they assess the market value of the property, right? So this technical team that I am talking about, they can be external or they can be internal. They can be external or they can be internal. When we talk about the external technical team, they are independent entities. They are having offices all across the city or nearby areas. So they are technically qualified persons sitting in those offices, like doctors have opened their practicing offices, CA opened their offices. Similarly, these technical engineers, they also open their offices. You may have also seen these offices in your areas also if you are living in comparatively a bigger city. So these agencies gets empaneled with the banks. They first need to get empaneled with the bank to be eligible to do their valuation, right? So these external agencies, in common terms, they are called the valuers. In banks, you will see every employee using the term valuer for these external agencies, right? So these are called the valuers. Now question is, who manages this team? This is an empanel team, this is an external team to the bank, and there is another team, that is the bank staff. So who actually controls them? Who actually manage their performance? Who actually assign them tasks? Who actually pays them their respective fees? Who actually gets the report from them? Who actually who actually analyze the accuracy of their reports? So this management of the external agencies are kind of divided across teams in some banks, while I want to say that the management of external technical teams, the valuers, can be managed by different set of internal teams. It all depends on different type of banks, NBFCs, their internal policies, their internal processes. In some of the banks, the entire external agency is managed by the sales team only. The marketing team of the bank handles the external agencies. These sales team members initiate the valuations to this team, ask them to go to the property and assess the market value. The valuers submit their reports to them, and they also sign the reports on behalf of the bank that they have verified the report. So in some banks, sales team handles this. Now in modern times, this task is getting started to be given to the credit team, because they are considered more focused on policies, compliance of policies and processes. They are more compliant to policies and processes rather than the sales team, obviously, for obvious reasons. So in some banks or NBFCs, credit team standalone handles the external agencies on their own, like the one we have studied in the first part. In some banks, the operations department, you must have watched the different departments video that I have done earlier. The operation teams handles the external agencies, right? So, but in some banks, there is separate internal technical team hired by the banks also. The banks hires internal technically qualified persons also to handle these externally qualified persons with the same level of qualification, right? So internal technical team in some banks or NBFCs can be there to manage them, then they are called the technical team, right? So but this is what I am going to discuss here. When we talk about the technical team, this can be internal also. So by internal, we mean they are the internal employees equally technical qualified. They work independently. Independently means they are not managed by any of these departments. They are a separate department altogether. They are a department within themselves, right? So they are called technical team within the banks usually, right? So the valuers goes into the market, see the property, measures the property direction, dimensions, assess the property market value, and submits the full analysis report, which we called a valuation report, to the banks. So considering some properties are of large areas or with a higher value, say of more than 10 crore value, more than 20 crore value, then in these cases, banks want to be doubly sure about the accuracy of the valuation. So for larger properties in terms of value or size, they may ask two or more valuation reports for the same property. They will send two different agencies to measure the property to give the valuation, and then they compare the value given by these two agencies and they choose the lower value, the lowest of the value as their final market value, right? So these external agencies assess the fair market value of the property. The fair market value. By fair market value, we mean these external agencies or the internal technical teams look into the risks associated with the property from the point of view of bank primarily. Since they are working for the bank, so they are primarily concerned with if the loan gets defaulted, if the borrower does not repay the loan on time, and the banks goes into the market to sell the property to recover their loans, then how much this property is expected to fetch to the bank, right? That is the fair market value from their part. And that is why when practically speaking, when the banks goes into the market to sell the property, it does not recover the full market value. That is why the difference is there in the valuation report of the banks and the valuation report presumed by the borrower. In many cases, you will see, in most cases, you will see the borrower will say, my property value is 5 crore rupees, my property value is 3 crore rupees. But when the valuer submits their valuation report, the property value comes, suppose 4 crore rupees, the property value comes, suppose 2 crore or 2.5 crore rupees. It is always 20-30% lower than what is presumed by the borrower. And why this difference is there? Because the valuation of fair market value valuation is given on a very conservative side by the valuers to the bank, right? So they do the market study, they assess the location of the property, nearby area, size, locality, approach to the property, how much wide the street is. There are multiple factors that are looked into by the valuers. Technically, they are technically qualified, say they know better how, what is exactly looked into by them. So they look into the different factors and give a final value to the banks, right? So these valuers, these technical team, not only gives the fair market value of the property, but they are also responsible for the property identification part. We will cover it in the coming videos, what is property identification, but they are very much responsible for the property identification part. And technical clearance of the property means giving a clear valuation report that the property is technically clean to mortgage for the banks. There is no hitch in the property, there is no risk associated with the property, or if there is any kind of risk, like in the title deeds, the area of the property is 200 square yards, but at site when they measure the area, actually it is actually only 180 square yards, or the property is built up in such a manner that it is not complying the local bylaws of that city, local construction laws, local governing laws of the city, the construction is illegal. So they have to report everything so that banks can know that whether the property is clean or not, whether they can easily or without fear they can mortgage the property or not. So they are responsible for technical clearance of the property to the bank, and if they need any special documents, any additional documents to give a clearance to the property, then they have full right to take that document upfront from the client or the borrower. They will ask the respective sales team or marketing that we need this document from the client, from the borrower, if he wants us to give a clear and clean valuation report, right? So this is a technical clearance. And now property identification. Property identification, friends, is a very critical part. So you have a sale deed of the property. In sale deed, the address of the property is mentioned, right? So the address of the property needs to be verified at site. There could be a possible scenario where the borrower is showing you X property, but the title deed which is getting submitted for mortgage is related to some other properties. There are practical cases where such kind of frauds have happened. So it is very much critical for the technical team or valuers to assess whether the title deed of the property which is given to us, which is going to be mortgaged with us, and the property at site which is getting valued by them are one and the same properties or not. So this is called property identification. We will discuss this later in a very detailed manner. So property identification is done by them. So the valuers are, because they are giving technical clearance of the property, they are doing a property identification. So they are legally responsible. They are signing their reports. So they are legally responsible for the correctness of the report. So for example, they have submitted a clean report, and a few years later the default comes in the loan. The bank files a fraud case against the borrower, and in the court the borrower says that I have mortgaged the X properties, but the bank was thinking that they have this Y property, and they see the valuation report that the valuation report was given for the Y property, but the documents was given for X property, means the borrower was right. So that means the valuer has given incorrect identification of the property. So he will be fully responsible for the act that he has done. So they are legally responsible. That is why they can ask for additional documents to give a clear technical clearance report, right? So the report that they submit is called the valuation report. Obviously, I have told you earlier, or the technical report of the property, right? So if the report is submitted by the external agency, so if the external agency is doing the valuation in some, remember guys, when I have told you that 2 or more reports are required for larger properties, some banks have external valuers also, and they have internal technical team also. So they may take 2 valuation reports from different 2 impaneled agencies, and they can ask 1 report from their internal technical team as well. They can, because they are technically equally qualified also, they can ask them to go in the market and assess for themselves what is the property value given by them. So they can finally take lower of the 3 as a final market value. While in some banks, there are no external agencies and all the valuation part is done by the internal technical team only, because they are equally qualified to do the valuations, right? So the banks may have different criteria to do the same, and if there is external agency, then their report needs to be vetted by the internal team, whosoever is managing them. If sales team is managing them, then they okay the report. The credit team is managing them, then credit team has to okay the report, right? When I was in HDFC Bank in 2016 in lab product, then in my department I was responsible to vet the valuation report of the external agency. So I was the one who was handling my external valuers, right? So internal team I have already told you, credit managers, technical team, sales team, operations team, etc. So this is it guys. This was class 16. In the next class 17, we will come up with more interesting topic. Thank you for watching. Thank you very much.